Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the theory for Chapter 5, which is about inventory. Go back and watch the first video there. It was an introduction. I'll just quickly show the screen here and briefly go over that. I talked about, looking at, here's the link. Let me do it in blue. Here's the link to go to on the student community for additional videos on about inventory, because all of this chapter was covered in Math for Business and Finance. And in the last video, we talked about goods available for sale and what that is in comparison to what cost of goods sold is. And since these are theory videos, pause, rewind, watch the videos again if you don't understand something. And if you're still not getting it, then definitely telephone and speak with an instructor. I'm going to make a little note here that when it comes to doing the problems, I'm just going to give a quick, the assigned homework problems. I'm just going to give a quick, disclaimer, and I'm not going to spend 2 or 3 or 4 minutes, repeating myself, that if you're not getting the theory, you need to watch the theory videos. Doing the homework problems is application. Okay, if you're doing the homework problem and you're looking at the application, you should be able to understand the application by watching the video. But if you're not getting it, then you're missing something in theory, and you need to come back and look at the theory. Right? So for this video, I'm going to cover specific ID and average cost. Okay. Let me jump back up here. There's 4 inventory costing methods: specific identification. Let me get my pen here again. We have specific identification, FIFO, LIFO, and average cost. So I'm going to be looking at, in this video, the specific identification and average cost, because they're the 2 easiest. They're the ones that students don't seem to have as much trouble with. So here, for specific identification, I am not using this exhibit. This exhibit I'm going to use in demonstration of average cost. Okay, so with specific identification, the way I'm going to explain this is, it's difficult to keep track of inventory when you have such, let's face it, there's so many different products. Okay, they've created 4, different inventory methods in order to be able to cover these different products. If I have a car dealership, an automobile dealership, right? I might have 100 cars on the lot. Maybe I might have 1,000 cars on the lot. Okay, but each one of those cars I can identify specifically, meaning, if somebody comes on the car lot and they're looking at, and I number my cars, let's say they're looking at car number 950, okay, and that happens to be a Ford F-150 truck, right? I can specifically identify that vehicle, okay? So when it comes to specific identification, we start out with a beginning inventory of whatever that dollar value amount is, okay, which is the total value of those 1,000 cars. And let's just say that happens to be 1 million, okay, $1 million. Okay. Now, when somebody comes on the car lot and they buy this Ford F-150, and let's say that Ford F-150 we bought from Ford, okay, remember Ford's the manufacturer, and it cost us $25,000 to buy, okay. Well, when that leaves our car lot, when the customer buys it, now our inventory from the 1 million, we take out the 25,000, okay, and now we know the value of our inventory is 975,000, okay. 975,000 is the value of our inventory, right? Because we're able to specifically identify that particular vehicle. And if a truck comes up on my lot, all right, and now delivers, all right, so if I had 1,000 cars, 1,000 vehicles here, and I just sold one, I have 999 left. That 1,000 is $1 million, right? That one I sold is 25,000. Okay, so now my 999 vehicles are worth 975,000. Okay, now let's say the truck pulls up and they drop off 10 more vehicles, and the value of those 10 more vehicles is, say, let's say, I don't know, 200,000, right? Is now worth 200,000. Okay, so now in inventory, I actually have, I'm going to add 10 to my inventory, so I have 109,000, and the value of that is the 975,000 plus this additional 200,000, or 1,175,000. Okay, so all specific ID is just what's going in is what's coming out. Okay, and you're specifically identifying, you're keeping track of everything that goes in and out, and that's possible because you're dealing with cars. Okay, you're dealing with big items, things like furniture, cars, what else, swimming pools, these big items that you can identify, you generally deal with on a specific ID basis. But what if you're a plumber, okay, and you have fittings, all right, electrical fittings, plumbing fittings, carpentry, you have wood, M&Ms, okay, grocery store, you have all of these items in a grocery store. Using specific identification is no longer viable, because let's face it, I mean, you're standing in line and that person has 15 items in the cart, the next person has 35 items in the cart, you have got 7 in your cart. You can't be going in and out of the inventory all the time, all right? So you end up having a beginning inventory. You look at your purchases, right, which gives you your goods available for sale, right? And then you do a physical inventory, right? You do a physical inventory to see how much, and you extend your inventory to see how much the dollar value of that physical inventory is, and then you adjust your books so that you have the correct beginning inventory. But the question becomes, well, how are we going to cost things? Okay, if you're in a grocery store, I mean, you have thousands of items, and those prices are generally moving, day in and day out. I mean, think about something like along the lines of lobster. It's not the same price every single day. Okay, you look at let's say you manufacture O-rings for jet engines, and that's aluminum, right? Well, the price of aluminum changes every day. Okay, so even fittings, for the plumber, they, granted, I go in and I buy this fitting and it might cost $3 today, but 2 months from now that might cost $2.05. 2 months later that might go down to $1.95, depending upon the price of the metal. Okay, so the price actually fluctuates. Whereas with that car, when the car is 25,000, it's 25,000. It's not going to fluctuate, because once it's manufactured, that's the price associated to it. But when you're taking a box and you stick in 100 fittings at 250, right? And then, you're taking some out, taking some out, taking some out, and then you buy more at 265 and you stick them in. The plumber, he's coming in as there's no price on that fitting, so that he knows he's supposed to take out the one for 250 because they were the first ones in and they're the lower price. No, he's just grabbing. Okay, and that's where this idea of average cost comes in, because if I have this box and some of them are 250 and some of them are 265, and I'm not going to identify, since they look exactly alike, I can't identify that that's the one I bought for 250 and that's the one I bought for 265. What I do is I say, okay, I have 75 left in there, and I'm going to figure out what my average cost is, and apply that average to all 75 of those fittings, right? So this gives me a more realistic valuation of my inventory, okay? I mean, absolute would be, I knew which one was 250 and which ones were 265. But from an efficiency standpoint, there's just going to be too many errors. Nobody's really going to pay attention. So it makes absolutely no sense to try to do specific ID on something like that. And that's why we would use average cost. So now we're going to look at Exhibit 5-7 here. And I'm going to kind of try to explain this. On September 1st, we have purchases, cost of goods sold, and the inventory on hand, right? So here's my total cost. This is the column that is most important, okay? On September 1st, we had one on hand, and that one unit was $40. So our total cost of our inventory is $40. Now on September 5th, we're going to purchase 6 more at $45, okay? So our total purchase is $275, right? Now, this is purchases. This is when we're buying and we're sticking those items. We're putting those items into the box. That's purchases, okay? Our cost of goods sold, okay, is when we're taking them out of the box. That's our cost of goods sold, meaning we're taking it out and we're using it. We're expensing it, okay? So, and when we have a purchase, we're using the purchase column, but when we actually sell something, we take it out of the box, and I'm only using the boxes as an example, okay, in order to visualize what's going on here. So that we would use our cost of goods sold column, all right? So on September 5th, we buy 6 more at 45. The 45 is what's important here. Yes, our total cost on the invoice is going to show $270. When we look at now the quantity, we know we have 7 in that box. And if we take the 270 plus the 40 from the 1, right, we have a total value of 310, okay? That's our total cost. But notice now that our unit cost is only $44.29. And the way we get that is we take the 310 and we divide it by the number on hand, the quantity on hand, which is 7. And that gives us $44.29. So now instead of trying to find that one that costs 40 and the 6, try to specifically identify the one that costs 40 and the 6 that cost 45, no, we take the average and we say they all cost $44.29, right? So from a timeline perspective, all right, if I'm sitting in the office, on September 1st, I had a beginning inventory. Well, now today is September 5th, all right? And as far as I'm concerned, what's in that, those items in that box, each one, has a cost of $44.29. We don't know what's going to happen for the rest of the month, all right? Because today is, September 5th, right? But so we know that that's the amount, all right, and that's per item. Now, as we go forward, we don't know if we're going to buy more, and we don't know if we're going to sell, all right? So we move along in time, right? So we go in time, and now it's 9:15, right? And on 9:15, we can see that, oh, well, we're actually selling because we're using cost of goods sold. We're taking them out of the box, right? We're taking 4 of them out, okay? Well, when we take them out, remember our unit cost, we had said, oh, our average cost is $44.29, right? So when we take them out, we're taking 4 of them out at that $44.29, which gives us a total cost of $177. So if I take the 310 from 9.5 and I take out the total cost of 177, that gives me 133. So the value of my inventory on September 15th is now 133. And since I had 7 and I take out 4, I have a remainder of 3, right? My unit cost is still 429. So what I want you to notice here is that when you're removing, when you're selling something and you're taking out items, you're using, they become your cost of goods sold because we're moving them from inventory and we're putting them to cost of goods sold. When we do that, when we take them out of inventory and put them to cost of goods sold, our unit cost doesn't change. Okay, our unit cost only changes when we actually make a purchase. All right, so just kind of like be aware of that. Okay. I don't have to go back and do the math to figure out what my new unit cost is, because I had 7, and when I take out 4, I had figured out the unit cost when I had 7 at 44.29. Well, all 7 of them are 429. The 4 that I sold and the 3 that are still in there, they stay the same at 429. So when you have cost, when you're taking something and putting it into cost of goods sold, it doesn't change your unit cost. Your unit cost only changes when you actually purchase something. So now it's 926 and we're going to buy 7 more. Well, when we go to the store, right, those 7 cost $50. Remember, our first one had cost 40. When we bought 6 more, they cost 45. Well, now the price has gone up to 50. Okay. Well, the total price on the invoice for the 50 is 350, right? So I have $133 of what the value in my inventory was, and now I'm going to add 350, which gives me $483, right? So now that's the value of my inventory on hand, but my unit cost is going to change. Why? Because I had 3 before, and I just added 7, so now I have 10 in my inventory. But the total value of my inventory is $483. The total of my value of my inventory is $483. So if I have 10 of them, and that's the total value of my inventory, that means each one in my average inventory cost for each one is now $48.30. So I have a new unit cost for each and every one of those items. Yeah, these 3 here that were at $44.29, yeah, the value of those changed. Now they're worth $48.30. Okay. Right, so we're at we're on September 26th here, and now we have 10 items in our inventory, and each one now has an average cost of $48.30, but our total inventory cost is $483. Realize that the total cost is based upon the actual money going in and money going out. Okay, we figure out our total cost, and then we figure out our unit cost. So now on 930, we're actually going to use 8 more. So 8 more are going to come out. Well, again, when they come out, the remaining amount, the 2 that remain in there, the unit cost stays the same, because the 8 at 48.30, right, has a value of $386. That's what's coming out. I have 483 less the 386 that I had taken out, means now I only have $97 in my inventory, but the unit cost for each one stays the same. All right, so if I take 2 times 48.30, I'm going to get the 97. I mean, obviously they rounded here. Okay, but my unit cost stays the same. Only the total amount, that's the total value of my inventory on hand, changes because I took them out. Okay, so you're keeping track of this on a day by day, moment by moment basis. Every time there's a change, okay, every time you purchase something or you take something out of cost of goods sold, your inventory on hand changes, and you're always constantly updating those values to know what that average cost is. All right. Now, as a double check, you could say, well, I bought 13 and that was my total cost for my invoices. Okay. and I sold 12, and I had calculated my total costs to be 563. Okay, excuse me. Um, so when you look at it, what's the difference between 620 and 563? 97. Okay, so you end up with the same inventory value and you have the same quantity on hand, and obviously your cost for those two is the 48.30. So that's how the average costs work. Um, you know, this is another explanation of it. And again, if you're having a tough time with this, go back to the math videos in the student community. Watch those. And if you're still not getting it, then feel free to telephone and speak with an instructor. Okay. All right. So in the next video, I'm going to actually start talking about FIFO and LIFO. All right. Until then.